Today we are talking about what I deem to be the top 3 dividend paying companies that I own in my own portfolio. I'll be sharing some insights as to why I own these companies, why they are good dividend payers. Obviously right now it is a challenging place to be in the market. We've seen a sell-off within the past week or so, and these dividend companies could be a good place to hide out, but make sure you stay tuned at the end. We're going to share an ETF which could give you great exposure to all of these companies. If you're new to the channel, my name's Nick and welcome to Ways to Wealth. As we mentioned in the intro, today is all about dividend paying stocks that trade on the Toronto Stock Exchange. I personally like dividend paying stocks. A lot of people have a lot of mixed emotions when it comes to it, but it's all about cash flow and returning that cash flow back to shareholders. So we'll start out the video by talking about what I consider to be a staple in many Canadians' portfolios, and that is Royal Bank of Canada. Obviously, there's a lot of history within the financial sector here in Canada. These companies have been around since the 1800s, and RBC started to first pay a dividend in 1870. And this is something that they've continued to add and grow into, and that is why it has the largest market cap on the Toronto Stock Exchange, and obviously it does some great things on the business sense. Now, when you look at this company from the grand scale, we're looking at it from a perspective that there's not much competition in Canada. I think I read a stat the other day that there's 4,000 companies in the US in the banking sector. In Canada, we don't have as many. There's really considered to be big six. There's six, and sometimes they consider 5 plus National Bank. But there's really not too much competition in the Canadian marketplace. So that is definitely one of the benefits towards owning this company, but it also does really good in an economic downturn. The price has definitely dropped in the past couple of months with the fears towards the mortgage crisis. We'll touch on that in a little bit, but it did deal with certain scenarios like this in the past. More recently, the 08-09 financial crisis. Many companies in the US were hit by it, but these companies in Canada were well established and were able to evade getting any handouts from governments or from other parties. So we'll take a look a little bit further at Stratosphere here to get a better understanding of how this company has performed. The data doesn't go back to when it started being publicly traded, but we can see on this long run chart here, it does grow its capital. And this is something you may hear me say a couple more times throughout the video. Dividend payers are good, but it's also nice to see the business growing as well. So we'll take a look and we can see that the company has performed very good. We can see over the long run, it's up a percentage change of, over 1,700%. In the short run, you look at the kind of stable or steady growth. It has grown only about 1.24% in the past 5 years, but also the dividend has grown as well. So we need to take that into consideration. And we can see some of these numbers from this dividend portion right here, which is dividends per share growth over the past 3 years has grown 7.35%, and that trend has been pretty consistent, especially past 5 years and then past 10 years as well. In terms of the future growth, what the estimates and what the company is projecting is another 6.84% in dividend growth. So not only do we have the capital appreciation, not only is the stock price going up, the dividends are also increasing as well. So that is why I own Royal Bank in my portfolio. The second company that is a new addition to the portfolio, if you're a fan of the channel, a couple weeks ago we talked about dividend growers and I decided to add this one in, and that is Alimentation Couche-Tard. And this one is super special, and we're gonna find out a little bit why. But if you don't know about this business, they do your convenience stores, the gas stations. This is where they built a bulk of their business. And obviously, because this is not a growing sector, the way that they are growing is through mergers and acquisitions. So they're looking to gobble up their competition. So let's break down the numbers a little bit just to get an understanding of just how much of a dividend grower they are. And we'll jump down to the dividend section and we can see they've grown the dividend almost 28% in the past 3 years. And when you forward that out to 10 years, it's been about 23% alone in the dividend. Now, I will warn you, when we look at the dividend straight up, it's less than 1%. So it's nothing that is kind of shocking, or the 5%, the 6%, the 7% that we're seeing in the market today. But the most important thing is that they're growing that dividend. And if you can buy in at a price today and have your dividend grow, well, that is beautiful. Just quickly looking at the chart here, we can definitely see over a longer term, it has performed relatively well. So we're getting that capital appreciation, the share price growth with the dividend growth. How can you go wrong? They want to return capital to the shareholders, but they also want to grow their business through mergers and acquisitions. I think it's one of the best models today and definitely great additions into the portfolio. To highlight more on that dividend growth that I was talking about, I was able to find this site which gives a projection based on history. I know history doesn't repeat itself, but based on history, if it continues on its certain path, we can see what they're going to pay out per share over the next 10 years or so. And we can see that there is definitely going to be continued growth. Now, what does that mean? That means that if you buy today and it's paying out roughly 52 cents a share based on this website here, we're getting a 0.76 dividend yield. That's your yield on your cost today. And if you didn't buy any more and they continue to increase the dividend, well, these percentages would show you what your yield would be on the original purchase price. Forget what it's trading at in the market. It would show you if the price of the stock stayed the same, this is how much you'd be getting yielding return on the shares that you've purchased. And we can see in just a short period of time of 10 years that you would be getting more than double the dividend yield that you're getting currently today. And one of the facts that it threw out here is that assuming an annual dividend growth of 11%, which we've seen it be at about 23%, which could not be stable, but just taking 11% to be conservative, the dividend would double every 6.3 years, which is super cool. And that's why I kind of decided to move into this company, because we're also seeing capital appreciation. And the fact that the dividend is growing is always a great sign. The third company that we're going to talk about is a newly crowned dividend king. Now, there's not many of these on the Toronto Stock Exchange. They are one of two. And if you don't know what a dividend king is, it's a company with a certain market cap that has increased its dividend year over year for the past 50 years. Now, that is an incredible feat. That is something that is unimaginable, the business that is so stable, and that's due to the fact that it is a utility, and everybody needs a utility for power, etc. It's how we run our lives today, so this company will continue to be needed. And when we take a look further at this company, we can see by the chart that it's definitely performed very well. We see that upwards right trajectory, and that's because they are a price maker. They are not a price taker. And what I mean by that is that customers will pay whatever they say. And that helps in times of inflationary measures or when inflation is going higher, because they can push those costs off to the customer. And then they can continue to grow the business just in a matter of inflation, increasing prices. And you know what, at the end of the day, when we get our bills, we have to pay them if we want to make sure that electricity keeps on running in our house. And that's why this business is not going to be a huge grower, although the chart is definitely upwards and to the right, which is a great sign. And we also have sharing those profits or paying out the shareholder within that dividend. So we'll take a look at what the dividend has done. Currently, I believe the yield is around 4 or 5. It's not currently showing right now. It does have a relatively high payout ratio, which is a little bit of a concern, but that's in the sense that they're trying to pay out the shareholder what they're making on a year-over-year basis. We also have the dividend per share growth of 3 years at almost 6%. And this trend is relatively the same if we look back at a 10-year basis. We were able to find some of that information from that previous website, so we'll jump back to that, looking at what the potential 10-year growth rate could be for Fortis's dividend. And we can see, assuming an annual growth rate of 5.61%, which is right in line with what we've seen, the dividend will double every 12.7 years. So if you think that we're going to need electricity, energy, utilities in 12 years and could deal with your dividend growing double, well, this is a perfect company for you. And we'll take a look at what it's showing here, your estimated yield on cost. And currently you're looking at about 4.44%, going all the way up to 7.66 in 10 years. So just to wrap up the points that I've had, Royal Bank, there's not much competition. They've grown their dividend. They've held a dividend since 1870. Big Six, again, not many players in the marketplace. We have Alimentation Couche-Tard, which is growing their dividend massively. You also have the price appreciation from the mergers and acquisitions, capital growth, dividend growth. And we see here Fortis, a dividend king, one that builds itself based on increasing that dividend year after year. And it's a commodity. It's something that we need in order to run our lives. And it's going to be kind of recession or inflationary proof from their side, recessionary proof from a business standpoint. We also take a look at how we can play this from an overall perspective. And one of the ways that I've been able to find is playing off of that dividend king topic that I talked about with Fortis, our dividend aristocrats, which are 25 years of consecutive dividend growth. And there is an ETF. We've talked about it on the channel before, but just to highlight it again, if you wanted to own a bunch of these companies and didn't want to own the individual risk of owning one, we can take a look at CDZ.to. It's a Dividend Aristocrats ETF. We can take a quick look at the holdings, and we see many companies here that have consistently increased their dividends over the past 25 years. Some of which are kind of unbeknownst to our conversation today, but definitely great players on the TSX. So if there is any other dividend companies that you like as opposed to the ones that I mentioned today, let me know down in the chat. Let me know why you like them, and I'll definitely have a little bit of a conversation to see if maybe I already own them today, and maybe give some other people some other areas to look at when they're reading through the comments. So I hope you enjoyed this video. If you do enjoy content like this, I cover the top ETF stocks on the Toronto Stock Exchange. Make sure to check out some of these videos that I'll post here to see what other ETFs that we've covered on this channel. I hope you all have a great week in the markets. Happy trading.